Welcome to yet another beautiful lecture when we'll be talking about profit and loss account. Okay, this is under lecture 6. Okay, now um, we in our previous lectures we've actually covered some magnificent, topics of which by now I believe you are actually a professional, okay, and you are able to understand things that we talked about. So let's dive into it. Okay, now, profit and loss account, what we mean basically, the actual concept is that when you buy something or as a business you get something for resale, you buy that item for resale. Okay, when you buy it, the amount that you buy is actually supposed to be less than the amount you actually sell. What that means is that when I buy a product at $20, I want to resell. I need to resell it at least $20. Okay, that could be at $25 or at $30. Okay, but in the case of me buying a product or manufacturing a product at $20 and I sell it at $15, it means that I have a loss. It means that I have a loss. So to an accountant, profit means that the amount, the revenue you get from the goods or from the product is greater than the expense for a set of transactions. So meaning that I sell it at a more price. Okay, so that's what we call a profit. Now, revenue means that revenue means the sales value of goods and services that have been supplied to a customer to customers. Okay. Now, um, the term expense means the cost value of all the assets that have been used up to obtain those revenues. Now, we have talked about three concepts. So, the first one, we are talking about profit. Profit means getting more from less. Okay, that's just a simple concept. Getting more from less. Then, when we come to revenue, revenue, we're talking about the amount of money, okay, the amount of money that is collected from the sale of what products. Then expenses, we're talking about the initial amount or the capital that you spend or that you use to buy a product for resale. That concept should be very simple. Now, if therefore we supplied goods and services valued for sale at, for instance, 100 pounds to customers, and the expenses incurred by us in order to supply those goods and services amounted to 70 pounds, the result will be a profit of 330 pounds. Okay, now this is an example. Let's look at it. Let's break it down. We've got that 100 pounds, right? So, of course, you get your calculator. 100 pounds, that is the value for the sale, okay, to customers, and the expenses incurred. We spent $7. I mean, 70,000 pounds. The result will be a profit. Okay, so meaning we subtract. Okay, we subtract. So the formula or the simple formula used, it is the sale value minus expense is equals to profit or loss. Okay, so if it is a loss, it is a negative. It is a If it is a profit, it's a plus. Okay, as simple as that. Okay, so whenever you see a negative, it means that it is a loss. Okay, or whenever you see an answer is written in brackets, it means that it is a minus. Okay, if that is clear, let's break it down. Okay, so we are saying that revenues, goods and services supplied to a customer for the sum of 100 pounds, okay, 100,000 pounds. Then less expenses, so the value of all the assets used up to enable us to supply these goods and services. So we've got that negative. Are you able to see the brackets? Remember, we indicated that every value in brackets is a minus. So our total now comes to 3,000 pounds. Okay, means 30,000 pounds. Okay, that is our profit. Okay, now on the other hand, it is possible for our expenses to exceed our revenues for a set of transactions. In this case, the result is a loss. For example, a loss would be incurred given the following. So let's look at this. So let's look at another case. Okay, let's look at another case for a loss. Now we've got revenues, what we have charged to our customers in respect of all the goods and services supplied to them. Okay, so we've got a 60 pounds, 6,000 pounds, 60,000 pounds. Okay, then less by value of all assets used up to supply these goods and services to our customers. So we've got 80,000 pounds. Okay, now there we minus. Okay, now as you can see, we are subtracting with a greater amount. So our answer will be 20,000 pounds. So as you can see, all of them are in the what? In the brackets. It means that they are subtracting. It means that they are subtracting. So as you can see there, the 20,000 pounds is in brackets, which means that it is a loss, which means that it is a loss. Okay, I'm sure that is very, very clear. So here, to simply do this, you can actually be able to use a formula, a simple formula, which is expense minus revenue. Okay, or revenue minus expense is equals to profit or loss. Okay, let's move on. The effect of profit and loss on capital. Now let's look at the effects of loss on different aspects of a business. So we're going to start with the effects of profit and loss on capital. Okay, how does loss and profit and loss affect capital? Now, businesses exist to make profits, and so to increase their what? Capital. Now, every business that we will talk about today, it is in existence because it wants to make profit. Losses, of course, may be there, but losses are an effect of maybe unforeseen circumstances and circumstances that are beyond the control of an individual. However, every business owner wants to make profit. Now let's look at the relationship between profit and capital in an example. Okay, let's just try to bring everything into reality. Now, on January, on January the 1st, the assets and liability of the business are one. Assets. Okay, so we've got assets in form of fixtures, which is worth 10 pounds, 10,000 pounds. Okay, these are assets. Remember, assets are in different types as we looked at in the other lectures. So we've got 10,000 pounds. Then stock. Okay, we've got a stock of 7,000 pounds, and the cash at bank is 3,000 pounds. So of course, as you can see there, that lands us to a total of 20,000 pounds. Okay, now let's look at the liability. Okay, liability is creditors. Okay, we have to give the creditors how much? That is a 200 what? 200 pounds. Okay, two yes, that is 200 pounds. Okay, now the capital is found from the accounting equation. Now let's look at the capital. There is always this thing is an equation, a balanced equation that you ever find. Okay, which is capital is equals to assets minus what? Liability. Okay, capital is equals to assets minus liability. Okay, so assets minus liability. Okay, now assets minus liability is our formula. So now let's find that. Okay, so in this case, capital is, remember we said 10,000 pounds plus 7,000 pounds plus 3,000 pounds minus that 2,000 pounds. Okay. Now we are subtracting assets minus liability. Remember, a liability is a cost, is an expenditure to a business. So we are subtracting our assets, meaning the value of property we have in form of stock. We are actually subtracting it from the what? We are subtracting liability, meaning that the amount we need to pay creditors, meaning the people that we are owing, that the business is owing. Okay. Now let's look at this. Let's simply look at this. So our total, using the formula, okay, using that equation, our total is going to land us at, okay, our total is going to land us at 8 18,000 pounds. 18,000 pounds. Okay. Now that is our what? That is our final value. Now during January, the whole of the 7,000 pound stock is sold for 11 what? Okay, 11,000 pounds cash. Okay, now that is during that period. Okay, now on the 31st January, the assets and the liability have become, okay. So further, I hope you are following. Okay, after selling the goods, the 7,000 stocks, 7,000 pounds stocks is sold for that amount, which is 11. Okay, of course we are able to see the difference. Okay, we ordered it at, we spent 70,000, I mean 7,000 pounds, then we sold at 11. Okay, so now we are, our new value is going to become fixtures and fitting. Of course we've got 10,000 pounds. Then uh, stock, of course, we've got new because of the we've sold all of them at 11,000. Okay, so we're going to become with new. Okay, in terms of assets. Okay, meaning that the value has moved from assets to cash. Okay, and cash at bank now has increased from three 3,000 pounds to 14,000 pounds. Now, I hope you are able to see the difference there. Okay, so meaning that the cash at bank has increased. Okay, creditors remains the same. So we're going to have, the capital is now at 22,000 pounds. 22,000 pounds is our capital. Okay. Now, of course, you use a formula, and we're going to get assets plus 10,000 pounds plus 14,000 pounds minus liability of 2,000 pounds. So we're going to have, so the capital has increased, right? Of course, you are able to see that the capital has increased by 4,000, from 18,000, okay, to 22,000. Now, it has increased by 4,000 increase because the 7 pounds stock was sold at a profit of 4 uh, 4,000 pounds for 11,000, okay, profit. Therefore, increase in a capital. Okay, therefore we've got an increase in capital. Now I hope this has been very simple for you to understand how we are moving step by step. So let me just quickly go through. So we had asset of 10,000 fixtures. Okay, then stock of 70 of 7,000 pounds. Now here on the stock, that's where the secret is. Okay, okay, so that's where the secret is. So that 7,000 pounds was sold for 11,000. Okay, now that 11,000, that's where our profit is coming from. Okay, so that's why we are landing at this 18,000 plus 4,000. Now this 4,000 is a profit, which now our total capital is going to reach to become 22,000 pounds because of the profit of 4,000 pounds. Okay, I believe that is very, very simple. So in any instance, in any exam, or in any example, or in any instance, you should be able to answer that with less uh, with with less difficulty. Okay. All right. Now, a loss, on the other hand, would reduce the capital. Okay. Now, let's look at the opposite of it. Now, the opposite of a profit, of course, we all know that it is a what? It is a loss. A loss meaning you lose. Okay. Instead of gaining, like we saw above, we gained a 4,000 pounds. But here we are talking about the opposite of that, which is a loss. Now let's look at the instance. Okay, so of course we've got old capital, loss, new capital. All right, meaning that it reduces the capital. Okay, it reduces the capital because profit added to the capital, and the loss is going to reduce the capital. Now, profit will be made when goods or services are sold for more than they cost, while the opposite will reduce in a loss. Okay. Now, profit and loss, okay, profit or loss and expenses. So let's look at another instance, profit or loss and expenses. Okay. Let's look at it. Let's look at it. Let's look at it. Okay. Now, once profits or losses have been calculated, you can alter the capital account. You can alter the capital account. So we're saying once profits or loss have been calculated, you can alter the capital account. How often this will be done will depend on the business. Some only attempt to calculate their profit and loss once a year, okay? Others do it at much more frequent intervals. Generally speaking, the larger the business, the more frequent profit are calculated. Okay. In order to calculate profit and losses, revenues and expenses must be entered into appropriate accounts. Okay. All expenses could be charged to one expense account. For this reason, a separate account is opened for each type of expense and for each type of revenue. For example, accounts in use may include, okay, accounts use may include. Now, just to re-echo this idea, okay, or just to put it in a different language, account is about account account is about entering businesses transaction in a well arranged manner. In a well arranged manner. Now, what are we talking about? What we are saying is that each and every expense has to, each type of an expense has to have its own category. Okay. The more clear it is to categorize these expenses, the more easier it will be in order for you to follow up and in order for your business to be to be evaluated. Okay. Now let's look at this. So commissions account. Okay, so this is one of the accounts, commissions account. Now this commissions account is a subscription account. Okay, so subscription account, so we're talking about rent account. So for instance, this commissions account, that's where you put details about rent. Okay, rent, and other things that you pay, is anything that you pay. If anything, there is anything that you rent, if your business is renting some vehicles, some expense account will be there for the rent. Bank interest account. Now, bank interest account, this includes motor expense accounts. Okay. So now, really, let me look at this. Let me actually redo the whole. I didn't explain it properly. I'm sorry about that. Let's When we talk about commission account includes all the commissions that the business encounters. Secondly, the business interest account. Okay, business interest account. So here, this account includes all the interests that the business gets or collects. Loyalties receivable accounts. So these are other expenses. Okay, so these are types of accounts that a business could have: overdraft interest accounts, subscription accounts, motor expense accounts, telephone accounts, general expense accounts, audit fee accounts, rent accounts, postgage accounts, stationery accounts, wage accounts, insurance accounts. Now, all these are separate accounts that are entered in a book. Okay, so each of these has got a page on its own, or it has got a book on its own, whereby all the transactions are entered under any of these accounts. Now, when you look at this critically, you actually notice that every business will make expenses out of any of the above accounts. Okay, the business will make expenses out of any of the above accounts. Okay, so it's about identifying which account a transaction is supposed to be recorded under. Okay, that's the aim of an accountant. Now, it is purely a matter of choice in a business as to the title of each expense or revenue account. Of course, here as an accountant, you can actually prefer, you can name the accounts depending on what you want it to have and how you want it to look. Okay. However, the purpose should be among any of the above. Okay. Now, for example, an account for postage stamp could be called postage stamps account. Okay. Now, postages accounts, communication expenses account, and so on. Okay. So you can actually choose which account you actually would want to categorize that under. Also, different businesses amalgamate expenses, some having rent and telephone accounts, others rent, telephone, and insurance account, etc. Meaning, here we are trying to say uh, different businesses have got different formats to which they name their accounts. Okay, so you as a business or you as an accountant need to pick which ones you'll be able to use. Now, infrequently or small items of expenses are usually put into sundry expenses account or general expense account. Now, this word sundry, okay, actually this word can actually sometimes confuse you. However, this just means small expenses or general expenses. Okay, general expenses may just may include maybe, for instance, day-to-day running. For instance, I'll talk about maybe lunch. I'll talk about maybe expenses like, rubbish pit, bins, or maybe council rates, all those things. Okay, some of those expenses, of course, some may be put in a in a different account. However, it is up to you as an accountant. Okay, most organizations use names for their accounts that make it obvious which accounts are for revenues and which accounts are for expenses. However, some don't. When in doubt as to whether an account is for revenue expenses, you have two obvious indicators to consult. The first is which side, okay, entries are mainly appearing. Okay, which side are mainly entries mainly appearing. So is it on the debit side or is it on the credit side? If, for example, it is the debit side, the account is almost certainly an expense account. The other indicator is the name of the business. Okay, now uh, is the nature of the business. Okay, now here we are saying that for you to determine what type of account that is, okay, either it is an expense account or an expenditure account, or it is a credit account, it depends on which side. Okay, so like we've indicated there. Okay, if for example the amounts or the entries are on the debit side, the account is almost certainly that it is an expense, because there you are all just including debits, only debits. Okay, now, a commission account is the accounting books of a firm of stockbroker, in almost certainly a revenue account. Okay, so a commission account we're talking about, mainly this is a case of commission account, other businesses may not have it. But basically, this one is talking about the stockbroker or any person, any business that is acting as an agent, or a business that is doing what? The business that is working on a commission basis. Okay, so this one may have a commission account where it is receiving all the commissions for all the transaction done. Now, let's look at another case. So this case is a debit and credit of a profit and loss account. Debit and credit of a profit and loss account. Now, you need to know whether expenses accounts, okay, accounts should be debited or credited with the amount involved. You know what assets involved expenditure by the business and are shown as debit entries. Okay, now expenses also involve expenditure by the business and should therefore also be debit entry. But why? Okay. Of course, it is because assets and expenses must ultimately be paid for. Okay. This payment involves a credit to the bank account or to the cash account. So the original entry in the assets account or in the expense account must be a debit. Okay. Now, even where uh, an expense is incurred on credit, the creditor must eventually be paid. Okay, the first entry will be to credit the supplier. Okay, suppliers. Okay, for instance, we're talking about the creditors. Okay, accounts and debits, the expenses accounts. So this further, it is an extension. Okay, now, when payment is made to a supplier, the bank account is credited and the supplier account is debited. Now, we indicated in our previous lectures that accounts is about transferring payments. Okay, so you are just transferring. If you take capital today of 10,000, maybe you buy a motor vehicle, okay, or a fleet of transport. That amount has been shifted from cash to what? To assets in form of to current asset, to from fixed asset, I mean from current asset to fixed asset. So meaning you are able to transfer. Now you should not be confused by now why we are moving all these adjustments. We are moving all these we are talking about all these terms. Okay, if you've got questions, please be able to email me or to talk to me about it. We'll be able to clarify. Now, for example, if you pay a rent of 500 pounds in cash, the asset cash is decreased by 500. Okay, that is clear. The accounting equation tells you that this means that the capital is reduced by each expense. If assets decrease, so does capital. If liabilities increase, capital decreases. Otherwise, the accounting equation won't balance. Okay, I'm sure that should be clear. If it is not, just repeat it and be able to understand. Very simple concept. Okay, now expense accounts contain debit entries for expenses. Of course, expense account contain a debit. So this is just a repetition of things that we've been talking about. Okay, just for emphasis sake, I want it to be able to sink in and for you to be able to understand. Okay, expense account contains debit entries for expenses. The second part of the entry will either be credit against an asset account, such as cash, or it will be a credit against a liability account, such as creditors. Okay, now revenue, like we indicated in the other in the other parts as we are beginning in the, I mean, in the preamble, revenue is the opposite of the expense. Okay, and is therefore treated in the opposite way. Okay, it is therefore treated in the opposite way. Okay, now revenue entries appear on the credit side of the revenue account. You've already seen this when you've entered sales figure as credit into the sales account. All right, now, because of that, revenue is collected together in appropriate named accounts where it is shown as credit until it is transferred to the profit calculation and at the end of the what? Of the period. Okay. Now, consider consider too the use of funds to pay for expenses which are used in the short term or assets which are used in the long term. both for the purpose of what? Both for the purpose of getting revenue. Okay, both for the purpose of getting revenue. Okay, okay. Now, so we are saying that both of these forms of transaction are entered into the debit side of the appropriate account. Okay, so which is an expense account or asset account, respectively, while the revenue which has been won is shown on the credit side of the appropriate account. Okay, now, so to summarize all that, we are saying that uh, profit belongs to the owners. Okay, profit belongs to the owners. That is clear. Revenues increase profit, so they increase capital, and that makes them credits. Expenses decrease profit, so they reduce capital, and that makes them debits. Okay, so the treatment of expenses is the same as treatment of assets. Okay, the treatment of expenses is the same as treatment of what? Of assets. So increase in expense result in debit entries, okay, to the appropriate expense account, while decrease, such as refunds for overpayment of an electricity bill, etc., among others, result in credit entries to those same accounts. Okay, now revenue is treated the same as liability. Okay, increases in revenue are credited to the appropriate revenue accounts, while decreases are debited to the same account. Now, let's it is actually shown in a very a simpler way. Okay, so we're talking about debit and credit. So debit, we are talking about expense, losses, and assets. Okay, meaning that we are it's a liability to the business. Okay, so we're talking about expenses, losses, and assets. Then when we talk about credit, we're talking about money coming in the business. So here we're talking about revenues. Okay, here we're talking about revenues. And what are those revenues? We're talking about monies that is received from the sale of goods and services. Okay, then we're talking about profits. Okay, liabilities as well as capital. Okay, so that is the money coming in the business. Okay, so it has been a wonderful, wonderful session to be with you. And more and more, I want you to go ahead and look more for more examples and see how best you can be able to get through profit and loss account. However, the secret to this study or to this topic is knowing which parts, which entries are expenditure, I mean expenditures or liabilities, and which ones are assets, or which ones are debits and which one are credit. Okay, so if you understand those two, you'll be able to enter all the appropriate accounts and actually balance up and form your profit and loss account. Thank you so much. Until we meet in the next session. Goodbye.